But let's talk about what we can trade around now, heading into an inflation number and into FOMC. Let's take a full gauge of the interest rate market and see what we can get done. How high will interest rates go, Jermal? Why don't you ask, actually, as a fun exercise here to start, it's of course a joke to be like, all right, Jermal, how high are they going to go?
Like you just did a second ago with oil? Is that what you're talking about?
But let's do like a fun exercise. We're going to talk about the 2-year, the 10-year, and the 30-year, where they're at, where their historical highs and lows have been, and where you might look to trade them as they continue to be really interesting assets here. And that being said, let's say, okay, the 10-year right now is at 3%. And by the end of 2022, where do you think the high for the 10-year will be? Is it 3%? Is it 3.5%, 4%? Is it, historically the 10 years gotten as high as 6 or 7%? Let's just throw like a ballpark guess that no one's going to hold us to for 2022 in the highs of interest rates.
3.5%.
Really? Okay. I would honestly, I think I'm right there with you. Like right now and let's take a look at where we've been and kind of measure what I think is a very measured response from Jermal. If you have other guesses, reach out to me or Jermal on Twitter at Frank_Caberna. You can find Jermal Chandler on there as well. He's usually good for, I think did one of your kids graduate this past weekend?
Yeah. On the 28th, graduated high school, man.
Amazing, man. Congrats.
Countdown is on until we kick him out of the house. Welcome to the real world, kid.
Congrats. Now get a job. Buddy. Get out of here. But yeah, congrats, man. That's awesome stuff. But yeah, reach out to us with your guesses for interest rates. And now let's give you some context. Interest rates at their highs, and we're looking at the 10-year. This is the barometer for a lot of traders, also the barometer for a lot of companies that are putting out, car loans and mortgages and everything else. Is this 10-year? We're at those highs, and I wanted to take a look at the 2s, 10s, and 30s, where they've been year to date, their highs and lows, and then also add about a decade's worth of data to put this context into 2010 until now, because you can see here, Jermal, everything 2s, 10s, and 30s are at their highs. They look to be operating pretty much similarly across the curve, right?
Yeah. And again, it's because of rate expectations that we've been dealing with, right? So I guess that kind of it probably factored into both of our assumptions here going forward, like how much rates are going to be going up. And, you do have to probably factor in a small percentage of policy error, but even still, we don't know when that's going to take place. So.
And that's why I think that your response is a really accurate one and a really measured one of like, we're at the highs right now. There's still kind of some mania of like, we're doing the darn segment, aren't we? Like, how high can interest rates get? And so I think they're pretty much at their highs, but I almost am giving it like 50 basis points, maybe 100 basis points of error almost of like they could get up there, but they'll settle in around 3%. And why I think that's really, really accurate. You look at the last decade's worth of data, and there's a bunch of interesting stuff here. First of all, the 2-year is at its highs for the last 10 years. You can notice that this measure here didn't really change. The high for year to date in 2 years is 2.8%. For the last 12 years, it's only 3%. So we're pretty much there. If you're looking to sell an interest rate product and you're looking for the best value, 2 years are the highest relative to their historical maximum. 10 years and 30 years both have some room to the upside. You can see here, going back to 2010, the 10-year high is 4%. And that's why I think, 3.5% to 4% is really where I think 10 years could get up to before maybe settling in. You can see 3% is a pretty average price, a pretty, fair value for interest rates in the long term. Now, if you're looking to buy an interest rate product, you think that interest rates can really pop off. The greatest value you're going to have is a 30-year that Jermal is basically halfway between its minimum and maximum. A lot of people saying, interest rates are crazy. They're so high. They're crazy high. Yeah. In the short term, in the long term, they're mid-range, my friend.
I know that's actually the one that I was fixating my eyes on. It's a good graphic you got here. I'm curious, for the 10-year and 30-year, those highs, did they occur in the same time or what? Do you remember?
So that's a great question. And no, they don't always happen at the same time. We've actually seen some interest rate inversions before. I mean, we saw inversions this year where the 2-year got to those highs and the 10-year didn't get close, and the 2-year actually eclipsed the 10-year, which is very abnormal. And so, no, these maximums don't necessarily happen at the same time, and they haven't historically. Now, the idea is that in the long term, trends higher in interest rates will lift. The rising tide lifts all boats, right? But there's always some transitory wonkiness for when the Fed, especially when the Fed starts to hike or the Fed starts to cut, where that front end of the curve will really outperform if they're hiking or underperform if they're cutting. And so I think there's a lot to take from this. How high will interest rates go? I think that, 3.5%, 4% really kind of is like, if they get higher than 4, that's some stuff that we have not really seen in the last decade plus of data. If you're looking to short interest rates, you're getting the best deal in the front end. If you're looking to long them, you're getting the best value in the back end. You want to do both at the same time. You got the spread market in here. I've got this on the long 30-year, short 2-year. You can see this has gone from $20 worth of difference in the futures, 2 full percentage points worth of difference, now down to less than half a percentage point worth of difference. And so that's my closing remark here. And I want to hear your closing remark as to opportunity or what have you, is that interest rates could go higher. We kind of created a little bit of a resistance at that 3.5%, 4%. Yeah, they could go higher, but rate spreads should normalize. If we do get a normalizing yield curve at some point, you should see this thing pick up to the upside and get back to 1%, 2% of difference. What say you as maybe a closing shot on how high interest rates will go?
I think these last 2 slides show the best reason why using those rate spreads are a lot more compelling than just trading one by itself. Like this kind of gives you the idea. We've seen the dramatic move in the 2-year all the way down to the point where I think this one did I don't know. It looks like it barely went into inversion in April, whenever that was, begin late March, early April. And now you see a situation where it's trying to figure out where it's going to go. I mean, the number we get on Friday could, we're going to get some movement around it, regardless one way or the other, because everybody's still trying to figure out. But I'd be interested to see if this eventually normalizes as well. Keep an eye, keep those rate spreads in mind. Keep these rate spreads in mind, because it's probably the best way to trade.
I couldn't agree with you more. Great closing arguments there from Jermal Chandler, my good friend. Don't forget to miss out. Don't miss out on him, I should say, on Engineering the Trade. He also features on Splash into Futures. He's on everything all over the Tasty Trade Network, and follow him on Twitter as well. Splash into Futures is coming up next. I'm going to get out of everyone's way here. Thanks everybody for watching. We'll have more small stakes tomorrow, but stick around. Splash into Futures up next. Have a great night. Peace.
Later.